Dan Ives of Wedbush Securities says the market is getting this wrong and that the recent tech sell-off is actually an overreaction. In a new interview, he explains why Apple is raising prices, why he believes the company will successfully navigate these challenges, and why investors may be underestimating the next big opportunity in tech. First, I'll play you Dan Ives' interview uninterrupted. Then, I'll give you my detailed reaction and break down exactly what I think he got right, what investors may be missing, and finally, I'll reveal my top 3 stocks to buy while they're still trading at discounted prices. Let's hear what Dan Ives has to say.
Now let's bring in Wedbush's Dan Ives for more on this. How do you read this today? What is the impact going to be on Apple? It feels like there's a lot of pain here. I'm looking at a quote from Tim Cook to the Wall Street Journal in mid-June where he said, quote, "This is a 100-year flood. I've never seen anything like it in any area in over 40 years.
Yeah, look, they had to do this, and it's our view, $150, $200 price increase on the iPhone as well. But when you put it, and you look at gross margins, and what this we're talking about 1-2% churn, maybe, on some of the high-end products. And I just think they're trying to get ahead of this. Now, ultimately, Intel and other partnerships they'll be able to sort of navigate this, their supply chain tacticians. But it just speaks to, it was sort of a nomad. They had to now raise the prices. This was the right time to make sure they do it, that margins do not degrade.
Trying to get ahead of it, I mean, they're reacting to it. How are they getting ahead of something? They're reacting to what they're seeing in the marketplace.
Yeah, Scott, I think at these price increases, I would actually view it, they waited as long as they could. I mean, you could argue they could have done this 6-9 months ago. And the reason they're doing this now is that they realize when it comes to, their elasticity and what they believe churn could be. When you look at the actual increases, we're talking, like we said, max 1-2% churn. So I think they recognize, despite what's happened with the stock, and I view it as an overreaction relative to what it's going to actually be from a demand perspective. The supply chain dictated. They held off as long as they could. But I think there'll be less price increases relative when it comes to iPhone. And they're going into a 3-year massive hardware cycle. They need to do this at the beginning of it.
Sure, but why is there an overreaction in the stock if there's going to be a reaction to gross margins? Whatever they do from a pricing standpoint, as you mentioned what the increases are, that's not going to fully make up or offset for the costs of what they have to pay for memory.
Yeah, I think when you put it through numbers, I mean, you're talking maybe from an EPS perspective, like I said, like less than 2-3%. So when you actually flow that through the model, and there's flexibility in there relative to street numbers as well, going into the next 12-18 months. And I just think we sit here a year from now, and the question will be, how come we have not seen the degradation so far that we expected based on the sell-off in gross margins and in EPS? They are supply chain tacticians. Cook's handing the baton to Turnus, but he will still be there in terms of, and his team, in terms of navigating the supply chain. And that's important because of what they need to do to make sure that they keep margins essentially where they are.
I mean, it's not just an Apple problem. We had news this afternoon. In fact, Microsoft reaching session lows today on news that they're raising Xbox prices. Quote, unfortunately, console storage and memory prices have increased by more than 2.5x. And we expect another doubling by the fall of 2027. That tells you that this issue isn't going away anytime soon. And Apple is far from the only one that's having to deal with these problems.
Look, we're talking about a historic price increases that we're seeing in memory. You see it to the benefit of Micron, SK, and Samsung. But, Apple, Microsoft, many others throughout the supply chain, they're going to need to navigate. But I think the most important thing here is, what is it going to translate to in numbers? And I think when you actually look at the next 1, 2, 3 years going into what's going to be just a massive hardware cycle for Apple, I think they've done it sort of baby steps here when you actually look at the overall price increases, and that's the smartest move. But Apple's been here before. It's not their first rodeo. They will be able to navigate. They'll have other partnerships, and then they'll be on the other side of this. And I think that's why we will look at this as an overreaction relative to this news.
What do you make of what's happened with the mega caps? I mean, you've got some of these names in a full-fledged bear market. You have others that are decidedly in correction territory. Now, I'm talking from their most recent 52-week highs. You got to be concerned about that. Are we entering an environment where investors think they've squeezed all they can out of these names for the time being, and they're just going to rotate into other areas, and then over the second half of this year, those names are going to underperform?
Look, I think there's definitely concerns. I mean, the calls that we're getting from investors obviously is massively up relative to what we're seeing on large cap. I think part of it is that AI is being funded by all the hyperscalers, from Microsoft to Oracle to Google to everyone. But the reality is the stocks are underperforming because it's almost like they're funding the AI party, but the ones that are benefiting are from memory to chip to supply chain to some of the infrastructure plays. I think investors are right now. We're in this CapEx we see, but we haven't seen monetization. Next 6 to 9 months, we see that. As we see that, I think you see a huge reversal, and then you start to get some of their pricing power back. And I think the sell-off you've seen here is, I think some of it's misguided, but some of it is just a fear of that this is going to continue as they fund it. Everyone else benefits, but they're ultimately, from a large cap perspective, they're the ones that the CapEx, the trillions of dollars, that's ultimately what the ripple effect that we're seeing in terms of this AI revolution play out.
At the center of this conversation is Apple's decision to raise prices. The company is dealing with a massive surge in memory costs, something that has been affecting the entire technology industry. According to the discussion, prices for memory and storage components have risen dramatically, and some forecasts suggest they could double again by late 2027. Dan Ives makes the argument that Apple really had no choice here. From his perspective, this is not a company suddenly becoming greedy or trying to squeeze consumers for every extra dollar. This is a company protecting its margins before these higher component costs become an even bigger problem. And honestly, I think there is some truth to that. People often underestimate how much of Apple's success comes down to its ability to protect profitability. Apple is one of the most efficiently run companies in the world. The company doesn't just make great products, it manages one of the most sophisticated supply chains ever built. Tim Cook built his reputation as a supply chain genius long before he became CEO, and that operational discipline has been one of Apple's greatest competitive advantages. Dan Ives believes Apple should have probably raised prices 6 to 9 months ago, but instead the company waited as long as possible. The reasoning is simple. Apple wanted to avoid upsetting consumers unless it absolutely had to. Now, according to Ives, these price increases could add around $150 to $200 to certain iPhone models. That sounds like a lot of money on paper, but his argument is that the actual impact on demand could be surprisingly small. He estimates that maybe only 1 to 2% of customers will decide not to upgrade because of higher prices. And if you really think about Apple's customer base, that estimate may not be unreasonable. Apple customers tend to be incredibly loyal. Many users are deeply invested in the Apple ecosystem. They own an iPhone, an Apple Watch, AirPods, a MacBook, an iPad, and they use services like iCloud and Apple Music. Once you're inside that ecosystem, switching becomes much harder. That's why Apple has historically been able to charge premium prices without seeing a massive collapse in demand. Personally, I think there is another factor at play here. Inflation has conditioned consumers over the last few years to accept higher prices on almost everything. Food costs more, housing costs more, streaming services cost more. So when Apple raises prices, many consumers may complain, but ultimately they still end up buying the product anyway. The host then pushes back on Dan Ives and asks a very fair question. If these costs are going up so dramatically, can Apple really offset them simply by raising prices? That is where Dan Ives becomes even more optimistic. He argues that when you actually run the numbers, the damage to Apple's earnings per share may end up being only 2 to 3% or even less. In other words, Wall Street may be dramatically overestimating how much this issue will hurt the company. This is an important point because the stock market often reacts emotionally in the short term. A scary headline comes out. Investors panic. The stock falls. But then 6 months or a year later, the actual financial impact turns out to be much smaller than everyone feared. Dan Ives essentially believes this is one of those situations. He predicts that a year from now investors will look back and wonder why there was so much concern in the first place. And this is where his long-term bullishness on Apple really starts to shine through. He keeps referring to what he calls a massive hardware cycle over the next 3 years. This is a very important phrase because when analysts talk about a hardware cycle, they are referring to a period where consumers upgrade their devices at a much faster pace than usual. The reason Dan Ives is so optimistic is because he believes artificial intelligence is about to create one of the biggest upgrade cycles Apple has ever seen. The idea is that future iPhones will contain increasingly advanced AI capabilities that require more powerful chips and more memory. Consumers who want access to those features may eventually be forced to upgrade. And honestly, I think this could become one of the biggest investment stories of the next several years. We have already seen what artificial intelligence did for companies like Nvidia. The next phase of the AI revolution may not just be about building data centers, it may be about getting AI into the hands of billions of consumers through smartphones, tablets, and personal devices. If that happens, Apple could be one of the biggest beneficiaries. The interview then broadens out beyond Apple and looks at the entire technology sector. Microsoft also announced price increases for its Xbox products because of rising storage and memory costs. This is extremely important because it confirms that Apple's problems are not unique. This is an industry-wide issue. Memory suppliers like Micron and Samsung are actually benefiting tremendously because they have pricing power right now. The companies that buy memory, however, are being squeezed, and this creates a fascinating dynamic in the stock market. Some companies are paying the bills, other companies are collecting the profits. Dan Ives points out that this same dynamic is happening in artificial intelligence. The mega-cap technology companies like Microsoft, Google, Amazon, and Oracle are spending hundreds of billions of dollars building AI infrastructure. They're funding the AI party, but in the short term, investors are rewarding companies further down the supply chain. The memory companies, the chip makers, the infrastructure providers. The companies selling the picks and shovels. This is actually a pattern we see repeatedly throughout history. During gold rushes, the people selling the equipment often make money before the miners do. During the early internet boom, companies providing infrastructure sometimes outperformed the companies that eventually monetize the internet. And Dan Ives believes something similar is happening with artificial intelligence. Investors are becoming impatient. They see these massive capital expenditures. They see billions and billions of dollars being spent. But they are still waiting for clear monetization. Where are the profits? Where are the returns? Where is the payoff? That uncertainty has caused many of these mega-cap technology stocks to underperform recently. Some are even entering correction territory or bear market territory. I actually think this is one of the most important parts of the entire interview. The market today wants immediate gratification. Companies announce huge investments in AI, and investors immediately ask where the earnings growth is. But transformative technologies don't usually work that way. The internet took years to become enormously profitable. Cloud computing took years. Streaming took years. Even smartphones took years before they fully transformed the economy. Artificial intelligence may follow a similar path. The spending comes first. The monetization comes later. And Dan Ives believes that once investors begin seeing meaningful revenue and profit from AI investments, there could be a major reversal in these technology stocks. In other words, today's underperformers could become tomorrow's biggest winners. That is why he remains optimistic despite all the recent volatility. Personally, I think investors need to be careful not to lose sight of the bigger picture. Yes, memory prices are rising. Yes, margins could come under pressure. Yes, these companies are spending enormous amounts of money on artificial intelligence. But none of those things necessarily change the long-term investment thesis. If anything, periods of fear and uncertainty often create the best opportunities for patient investors. Dan Ives appears to believe we are currently in one of those periods. He sees the sell-off as an overreaction. He sees Apple's price increases as a smart defensive move. He believes the coming AI-driven hardware cycle could be enormous. And perhaps most importantly, he believes the market is underestimating how powerful the eventual monetization of artificial intelligence could become. Whether you agree with him or not, one thing is becoming increasingly clear. The AI revolution is entering its next chapter. The companies building the future are spending heavily today in hopes of enormous rewards tomorrow. And investors now face the difficult challenge of deciding whether the current weakness in these technology giants is a warning sign or one of the biggest buying opportunities of the decade. Now let's dive in and look at the 3 top stocks that appear to be trading at bargain prices right now and could reward patient investors over the next decade. The first company on our list is Qualcomm, ticker symbol QCOM. For years, Qualcomm has been one of the most misunderstood technology companies in the market. When investors think about artificial intelligence, their minds immediately go to massive data centers and expensive AI chips powering chatbots and large language models. Because Qualcomm was never a major player in the early data center AI boom, many investors simply ignored the company altogether. That may have been a huge mistake. You see, while everyone was focused on AI inside giant server farms, Qualcomm was quietly positioning itself for what could become the next major phase of artificial intelligence. AI on your phone, AI in your car, AI in your smartwatch, AI in medical devices, AI everywhere. This is what the industry calls edge computing, and Qualcomm may have one of the strongest positions in this rapidly growing market. Edge computing simply means that artificial intelligence tasks can happen directly on your device instead of relying entirely on a remote data center. This makes applications faster, more secure, and often more efficient. Think about your smartphone being able to translate languages in real time, generate images instantly, summarize meetings, or run advanced personal assistants without constantly sending information to the cloud. That future is coming quickly. And Qualcomm has spent years building its technology for exactly this moment. Its Snapdragon processors have become some of the most powerful mobile chips on the market, and demand for these chips has accelerated as smartphone manufacturers race to introduce AI-powered devices. Even more interesting, Qualcomm recently entered the AI data center processor market. At first, investors did not seem to care much about the move, but sentiment changed dramatically after the company reported a strong fiscal second quarter and announced that it had secured its first paying data center customer. Suddenly, Wall Street started paying attention. The stock surged as investors realized Qualcomm might have more opportunities in artificial intelligence than previously believed. Of course, like many AI-related stocks, the shares later experienced some profit-taking as the broader technology sector weakened. But if you're a long-term investor, sometimes these pullbacks create opportunities. When I look at Qualcomm, I don't see a company that missed the AI revolution. I see a company that may be entering the next stage of the AI revolution at exactly the right time. And the numbers supporting this opportunity are massive. The global mobile artificial intelligence market is expected to grow at an average annual rate of around 26% through 2035 and could eventually reach $325 billion in annual value. That is an enormous addressable market. Even capturing a relatively small portion of that opportunity could translate into significant revenue growth for Qualcomm over the next decade. Another thing I like about Qualcomm is that it is not betting everything on one single market. The company has diversified into automotive technology, connected devices, wearables, industrial applications, and other intelligent systems that will increasingly rely on artificial intelligence. Modern vehicles are becoming computers on wheels, medical devices are becoming smarter, consumer electronics are becoming more personalized. All of these trends play directly into Qualcomm's strengths. And according to CEO Cristiano Amon, this edge AI revolution is only just beginning. Frankly, I think he may be right. We often focus so much on the companies building giant AI infrastructure that we forget where the real money could eventually be made. Billions of people carry smartphones every day. Hundreds of millions of connected devices are added every year. If artificial intelligence becomes a standard feature in nearly every electronic device we use, companies enabling that transition could become some of the biggest winners of the next decade. Qualcomm certainly has the technology portfolio to participate in that future. Of course, investors should also understand that this stock may not move in a straight line. Qualcomm has always been somewhat volatile. The semiconductor industry itself tends to go through cycles of optimism and pessimism. Investor sentiment can change quickly. There may be periods when the stock significantly underperforms the broader market, but sometimes the best investments require patience. The market often rewards investors who can look beyond short-term noise and focus on where an industry is heading 5 or 10 years from now. If edge artificial intelligence becomes as important as many experts believe, Qualcomm could end up being one of the biggest beneficiaries of this shift. The stock may not be everyone's favorite AI play today, but that is exactly why it deserves a closer look. Because some of the most rewarding investments are the companies that the market has not fully appreciated yet, and Qualcomm might just be one of those opportunities. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on our list is S&P Global, ticker symbol SPGI. Now, this is a company that many investors know by name, but very few truly understand. Most people hear S&P Global and immediately think about the S&P 500 index, one of the most important stock market indexes in the world. And yes, this is the company behind it. Every day, millions of investors, pension funds, financial institutions, and exchange-traded funds track or benchmark themselves against the S&P 500. Every time an investment product uses that index, S&P Global earns licensing revenue. That business alone is incredibly valuable. But here's the interesting part. The index business accounts for only a relatively small portion of the company's overall revenue. The real engine powering S&P Global is information. The company sits at the center of global finance because it provides something that banks, corporations, governments, and investors cannot operate without: data, ratings, research, and intelligence. S&P Global is one of the world's leading providers of credit ratings and financial market data. When companies want to issue debt, investors need to know how risky that debt is. When financial institutions make investment decisions, they need reliable information. That's where S&P Global comes in. Its ratings and data businesses have become deeply embedded in the global financial system. This creates an incredibly powerful competitive advantage. You can't simply wake up tomorrow and decide to become a major credit ratings agency. Building that level of trust, credibility, and global recognition takes decades. This is one of those businesses that enjoys what investors love to call a moat. Its products are mission critical, its customers rely on them every day, and the switching costs can be extremely high. Even better, these are businesses that tend to generate recurring revenue and strong cash flow. Now, despite these strengths, the stock has struggled recently. Shares sold off sharply after management issued disappointing guidance, and investors began worrying that artificial intelligence could eventually disrupt parts of the company's software business. The stock ended up falling about 24% from its previous highs. And whenever you see a high-quality business sell off that much, it's worth asking a simple question. Has the business fundamentally changed, or has the market simply become too pessimistic? I think that's the question investors should be asking right now, because underneath the headlines, S&P Global is actually going through a major transformation that could unlock a significant amount of value. Let's start with its ratings business. Higher interest rates have created a more complex financial environment. Companies are refinancing debt. Governments are issuing bonds. Investors are trying to determine where risks and opportunities exist. That complexity actually creates more demand for high-quality financial intelligence. And we already saw signs of this strength. The company's ratings revenue grew by 13% year over year during the first quarter. That's impressive growth for a business that many people consider mature. Then we have the company's market intelligence division, which sells financial data and analytics to institutional clients around the world. As markets become more complex and data-driven, the need for high-quality information only increases. Artificial intelligence itself may even create more demand for reliable financial data because AI systems are only as useful as the information they are trained on. In many ways, data is becoming the new oil, and S&P Global owns one of the most valuable collections of financial information in the world. But perhaps the most interesting development is happening behind the scenes. The company is streamlining its operations and focusing on its most profitable businesses. Recently, shareholders approved the spin-off of its mobility business, which provides automotive and transportation data. This may not sound exciting at first, but corporate spin-offs often create value. When companies separate unrelated businesses, investors can more accurately value each operation. Management can focus on what it does best. Resources can be allocated more efficiently, and sometimes hidden value finally becomes visible to the market. S&P Global is also selling its energy software business. Again, the goal is focus. Management appears to be saying something very important. We know where our strengths are. We know which businesses generate the highest returns, and we want to concentrate our resources there. I actually love seeing this kind of discipline from management teams. Too many companies try to do everything. The best companies know exactly what they are and what they are not. By exiting businesses that no longer fit strategically, S&P Global can devote more attention and capital toward its strongest competitive advantages. And here's the part that really interests me. The market does not seem to be fully pricing in these changes yet. Sometimes investors become so focused on short-term concerns that they completely miss the long-term opportunity being created right in front of them. The recent sell-off may be reflecting fears about artificial intelligence, slower economic growth, and uncertainty around financial markets. But those concerns may be overshadowing the fact that S&P Global remains one of the most important information companies in the world. Its products are deeply integrated into the global financial system. Its business model generates substantial recurring revenue. Its data assets are incredibly difficult to replicate, and management is actively repositioning the company for future growth. That's a very attractive combination. I also think there is another reason why this stock deserves attention. As artificial intelligence continues to evolve, the value of trusted information could actually increase. There is already so much data available today that investors are overwhelmed. Separating valuable information from noise is becoming more important than ever. Companies that provide reliable, verified, and actionable intelligence may become even more valuable in the AI era. S&P Global is uniquely positioned to benefit from that trend. Now, does that mean the stock will immediately bounce back? Of course not. Markets can remain pessimistic for much longer than investors expect. But if you're someone who likes buying high-quality businesses during periods of uncertainty, this may be one of those opportunities worth considering. Because at the end of the day, financial markets run on information, and very few companies provide information as effectively or as profitably as S&P Global. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock on our list is Chewy, ticker symbol CHWY. Now, I know what some of you may be thinking. An online pet supply company, with all the excitement around artificial intelligence, cloud computing, and advanced technology, why should investors pay attention to a company that sells pet food and pet products? Well, sometimes the best investment opportunities come from industries that are far less exciting but incredibly resilient. Because while technology trends come and go, one thing has remained remarkably consistent over the years. People love their pets. In fact, many people treat their pets like members of the family. And when consumers view something as family, they tend to keep spending on it, even during difficult economic periods. That's one of the reasons the pet industry has been such a powerful long-term growth story. Now, admittedly, Chewy has been facing some short-term challenges. The company recently reported earnings that met expectations and even exceeded sales estimates. However, management lowered its full-year revenue guidance and warned that the consumer environment has become increasingly difficult due to persistent inflation and tighter household budgets. Naturally, investors didn't like hearing that. The stock pulled back as concerns grew that consumers might cut spending on their pets. But I think it's important to keep some perspective here. Despite these concerns, Chewy's revenue still grew by 7.7% year over year. That is not the kind of growth you would expect from a company whose business is falling apart. In fact, it suggests something entirely different. It suggests that demand remains healthy even in a difficult economic environment. And there is another metric that I think is even more important. The company's auto-ship program now accounts for a record 84.4% of revenue. Think about that for a moment. More than 84% of Chewy's business comes from customers who have signed up to receive recurring deliveries of pet products automatically. That is an incredibly powerful business model. Why? Because recurring revenue creates predictability. It improves customer retention, it increases visibility, and it makes future revenue streams much easier to forecast. This is one of the reasons investors love subscription businesses. Once customers become accustomed to the convenience of automatic deliveries, many of them never leave. After all, if you have a dog or a cat, you're going to need food every month. You're going to need treats. You're going to need medications and supplies. These purchases don't simply disappear because the economy slows down. In many cases, pet owners cut back on spending for themselves before they cut back on spending for their animals. That emotional connection creates a powerful advantage for companies like Chewy. Now, let's be fair. The pet industry is slowing down compared to the explosive growth it experienced during and after the pandemic. Industry growth that once approached 20% annually is expected to moderate significantly over the next several years. Some analysts now expect the industry to expand at a pace closer to 4% through the end of the decade. At first glance, that may sound disappointing, but here's what I find interesting. Even if industry growth slows, the long-term drivers behind pet spending remain intact. Pet ownership remains high. People continue to humanize their pets. Veterinary care remains essential. And perhaps most importantly, consumers continue shifting their shopping habits online. This last point could become a major advantage for Chewy. The company is one of the most recognized digital players in the pet care industry. As consumers increasingly search for convenience, competitive pricing, and automatic delivery services, Chewy is exceptionally well positioned to capture that demand. In fact, a weaker economy may actually work in Chewy's favor. When money becomes tight, consumers often start comparing prices more aggressively. They look for discounts, they search for better deals, they become more value conscious. Digital platforms frequently benefit from this behavior because they make price comparison easier. Consumers can quickly compare products, find promotions, and conveniently have supplies delivered directly to their homes. Chewy's business model aligns perfectly with these changing shopping habits, and Wall Street appears to recognize the opportunity. Many analysts currently rate the stock as a strong buy, with consensus price targets implying substantial upside from recent trading levels. Now, that doesn't guarantee anything. Analyst price targets are not promises, but they do suggest that many professionals believe the market may be undervaluing the company's long-term prospects. Personally, I think Chewy is one of those businesses that investors sometimes underestimate because it operates in an industry that seems ordinary. There is nothing flashy about pet food. There is nothing revolutionary about delivering dog treats. But great businesses do not always need to be exciting. Sometimes they simply need to solve a recurring problem exceptionally well. And that's exactly what Chewy has done. The company has built strong customer relationships, developed a highly sticky subscription model, and positioned itself at the center of a large and emotionally driven industry. That combination is extremely difficult to ignore. Could the stock remain volatile in the near term? Absolutely. Could consumer spending remain under pressure? Certainly. But long-term investing is about looking beyond temporary headwinds. It's about identifying businesses that have durable advantages and allowing time to work in your favor. And when I look at Chewy, I see a company that still has meaningful opportunities ahead of it. The pet care industry is not disappearing, the emotional bond between people and their pets is not weakening, and the shift toward digital commerce continues to reshape how consumers buy everyday products. Chewy sits right at the intersection of those trends. That's why I think this is a stock worth putting on your watch list if you're looking for businesses that could quietly compound value over the coming years. So there you have it. Three very different companies. One is helping power the future of artificial intelligence on billions of connected devices. One sits at the center of the global financial system and provides some of the world's most valuable information. And one has built a powerful recurring revenue business around an industry driven by emotional attachment and long-term consumer spending habits. Each company faces its own risks, each company has its own challenges, but all three appear to be trading at valuations that may not fully reflect their long-term potential. And sometimes, that's exactly where great investment opportunities are found. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these three businesses has the strongest long-term competitive advantage? Is it Qualcomm's position in Edge AI, S&P Global's dominance in financial data and ratings, or Chewy's highly loyal and recurring customer base? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.